Welcome back to AlgoBot, the channel where we break down automated trading strategies one expert advisor at a time. I'm your host from AlgoBot, and today we're exploring a strategy called Inverse Fisher Trend Pullback, an expert advisor built for MetaTrader 5. This one pairs a classic momentum idea, the relative strength index, with a clever mathematical shaping tool called the Inverse Fisher transform, and then it trades only in the direction of a slower trend. By the end of this video, you'll understand how it spots finished pullbacks and rejoins an existing move. Let's dig in. And remember, this is educational content only. So what exactly is the Inverse Fisher Trend Pullback strategy trying to do? At its heart, this is a with-trend pullback system. That means it never tries to fight the dominant direction of the market. Instead, it waits patiently for a temporary dip inside an existing up move or a temporary bounce inside an existing down move, and then it looks to rejoin the trend as that pause finishes. The timing engine is where things get interesting. The strategy starts with the relative strength index, a well-known momentum oscillator. But rather than reading the RSI directly, it feeds the RSI through the Inverse Fisher transform, a mathematical shaping function that comes from the work of John Ehlers. This transform takes a soft, sometimes laggy oscillator and squashes it toward two extremes. Small, quiet readings stay near the middle, while stretched readings snap sharply toward the upper or lower edge. The result is a crisp, decisive signal that sits quietly during choppy conditions and prints a clean turn the moment a stretched move rolls over. Direction is handled separately by a slow trend filter, an exponential moving average, and its slope. The oscillator decides when to act, but the trend filter decides which way. The two never disagree, because the strategy only takes signals that align with the larger move. What market suits it? By default, it's designed for a trending major currency pair, such as the euro against the US dollar, on the 1-hour or 4-hour time frame, in a swing trading style. Because every stop and target is measured in units of the average true range, the logic adapts to any symbol or time frame automatically. This approach may appeal to traders who prefer patient, trend-aligned entries rather than constant activity. As always, this is educational information only, and trading carries real risk of loss. Let's walk through the exact logic the expert advisor follows, step by step. Everything happens once per closed candle, so the strategy is patient and never reacts to an unfinished bar. First, the strategy builds its oscillator. It calculates the RSI over a look-back period, 14 bars by default. It then centers that reading around the 50 midline and scales it down, applies a linear weighted moving average to smooth out the jitter, and finally passes the smooth value through the Inverse Fisher transform. The output is a single number bounded between -1 and +1. When that value drops below the negative signal level, the market is in an oversold pocket. When it climbs above the positive signal level, it's in an overbought pocket. The default signal level is 0.50. Next, the strategy checks the trend. It reads a slow exponential moving average, 100 periods by default, and measures its slope over the last several bars. The market is considered an uptrend when price is above that moving average and the slope is rising. It's a downtrend when price is below the moving average and the slope is falling. Now the entries. For a long, the EA requires an uptrend, and it waits for the oscillator to cross back up through the negative signal level. That upward cross means the pullback dip has exhausted and momentum is turning back with the trend. For a short, it requires a downtrend, and it waits for the oscillator to cross back down through the positive signal level, meaning the counter-trend bounce has faded. Exits work two ways. Every trade is bracketed with a hard stop loss and take profit, both measured in average true range units. The stop sits 1.8 ATR from entry by default, and the target sits 3 ATR away, giving a reward-to-risk ratio of roughly 1.6 to 1. On top of that, the strategy can take an early exit if momentum runs all the way to the far rail and rolls over, a natural way to step out of a move at exhaustion before the hard target is reached. Let's look at the actual MetaTrader 5 code driving this expert advisor. At the top, we have the input parameters, the settings you can adjust in the strategy tester. RsiPeriod is the momentum look-back, SmoothPeriod controls the weighted smoothing, and SignalLevel, defaulting to 0.50, sets how stretched the oscillator must be to count as a pocket. Trend period and slope look-back define the slow trend filter, while ATR-period, ATR-multiple-SL, and ATR-multiple-TP size the stop and target. There's also a maximum spread guard, a fixed lot size, and a magic number to tag the trades. In the middle, the code computes the inverse Fisher value for the bar that just closed and for the bar before it. Comparing those two readings tells us whether the oscillator has just crossed one of the signal levels. Now the two signal blocks. The long block reads, if uptrend and cross up through the lower level, then take the ask price. Place the stop 1.8 AT or below entry. Place the target 3 AT or above and call trade.buy. The short block mirrors it exactly. If downtrend and cross down through the upper level, take the bid price. Place the stop 1.8 AT or above entry. The target 3 AT or below and call trade.sell. Notice both sides are fully symmetric and every stop and target is normalized to the symbol's digit precision. That's the entire trading decision in just a handful of lines. Now let's bring it all together on a chart and watch two trades unfold, one long and one short. On the price panel, you can see the candles and a slow line weaving beneath and then above them. That's our trend filter. In the subpanel below sits the inverse Fisher oscillator, bounded between -1 and +1, with dashed signal levels drawn at +0.50 and -0.50. Look at the opening candles on the left. Price is climbing steadily and staying above the trend line, and the trend line itself is sloping upward. That's the uptrend condition the strategy needs. In the subpanel, the oscillator rides high as momentum pushes into the upper zone. So far, there's no trade. The strategy is simply confirming that a genuine up move is in place. Then comes the pullback. Over the next couple of candles, price stalls and dips back, pulling away from the highs. Watch the oscillator. It drops quickly, sliding down below the -0.50 level into the oversold pocket. This is the pause the strategy is waiting for, a dip inside a healthy uptrend rather than a full reversal, because price is still holding above the rising trend line. Now the key moment. On the buy candle, the dip exhausts and price turns back up, and the oscillator crosses up through the -0.50 level. Uptrend, plus an upward cross out of the oversold pocket. That's the long condition met, and the buy entry marker appears. The strategy places its stop below, at 1.8 ATR, and its target above, at 3 ATR. From there, the trade works with the trend. Price pushes higher candle after candle, reclaiming the prior highs and extending the move. The oscillator climbs back toward the upper rail as momentum returns. Finally, price reaches the take-profit target, and the trade closes for a gain in this illustration. 3 ATR of reward against 1.8 of risk. Now watch the character of the market change. After the peak, price rolls over and starts closing below the trend line, and the trend line itself flattens and turns down. That flips the regime to a downtrend, so the strategy now only looks for shorts. Inside that downtrend, price stages a small bounce, a counter-trend rally back up. In the subpanel, the oscillator lifts sharply and pushes above the +0.50 level into the overbought pocket. Just like before, this is a pause against the dominant direction, not a true reversal, because price stays below the falling trend line. On the sell candle, the bounce fades and price turns back down, and the oscillator crosses down through the +0.50 level. Downtrend, plus a downward cross out of the overbought pocket. That's the short condition, and the sell entry marker prints. The stop goes above at 1.8 ATR, the target below at 3 ATR. Price then resumes its slide, making a fresh low candle by candle, while the oscillator falls toward the lower rail. When price reaches the take-profit target below, the short closes. Two trades, the same logic mirrored in both directions, always in step with the trend, and always timed by the oscillator crossing back out of a stretched pocket. Notice we never spoke exact price levels, because the entries and targets here are structural, defined by the crosses and by ATR distance, not by fixed numbers on the screen. And that brings us to the end of our breakdown of the Inverse Fisher Trend Pullback Expert Advisor. We covered how it shapes the RSI with the Inverse Fisher transform into a crisp oscillator, how it uses a slow-moving average and its slope to define the trend, and how it times with trend entries as pullbacks finish, all bracketed by average true range stops and targets. Remember, Everything in this video is educational information only and not financial advice, a recommendation, or a solicitation to trade. Every strategy carries risk, and losses are a normal part of trading. If you found this useful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment telling us which strategy to analyze next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.